this is important slide. I mean, there will be companies within those 71 companies which would have not done 25%, but there will be companies which would have done much higher than even 25%. But all as a bucket, I mean, there will be one Hindustan Lever also in this, which would have done only 6-7%. But that doesn't distort. I think this Hindustan Lever's non-performance as a very deepest possible blue chips non-performance for last 10 years is not the sole reason for not buying blue chip companies. I mean, I think most of the, I keep getting this thing that, okay, Hindustan Lever didn't perform in last 10 years, so if you buy blue chips, you will not perform. No, it doesn't work like that. I mean, that's one accident which has happened. But if you buy as a basket, you are definitely going to outperform. It's like Mercedes versus Maruti. It's almost that kind of situation. If you put 100 Mercedes, 71 Mercedes in the race against 104 Marutis, eventually you will see that, of course, one or two Marutis might go ahead, some Marutis might go ahead. But as a lot, all the Mercedes will be far ahead of the race. You can see this very clearly here. The top line is that 25%, 9.3 times in last 10 years, whereas the non-EMCs are only 3 times. And that's how the retail investors or the people at large who have 90% of all these non-EMCs in their portfolio, they feel cheated because probably 3.1 time in 10 years is almost as bad or as good as your fixed income return. So why should you take the risk of equity and come here? He's better off probably investing in fixed income because the returns are not so good. And buying into those good companies is not a dharma because they look always expensive. And we have seen this performance irrespective of what is the earnings growth or what is the valuation to start with. I mean, we are not saying in 2003 these companies you have to buy very cheap. If you buy very cheap, then you make much better money. So it is valuation agnostic, and not even you don't have to. Once the complete edge is determined, of course you have to bother about earnings growth because to determine at what pace and the money is going to make. But broadly, this particular test is not bothering about the earnings growth or the starting valuation in 2002. One of the reasons, I mean, this is another insight which came from the, not from the book, but from one of the other writings by Michael Mauboussin. Why the blue chips, they keep, despite they look very expensive, if you look back, I mean, most of the money, large money has been made by blue chips only. I mean, ITC in the current year or 2 years or 3 years back, it was never cheap. And yet the most serious money has been made by ITCs of the world. I mean, if you look at the performance like Nestle, it looks very expensive, but in last 4 years, it has made about 37 to 38% plus dividends as the compounded rate of return. So I think the performance has been quite staggering, and the reason is that what happens is market keeps appraising the competitive advantage period, the excess profit period, and the value is put in the triangle form. What happens is after 5 years, the market says that competitive advantage period, okay, I mean, if I'm saying 25 years for in the first period, in 2000 I say it is 25 years, in 2005, after 5 years, I again say, sir, I was wrong in 2000 and the useful period of life of this company is still 25 years. So 5 years in the past, the profit made during those 5 years in the past has been the profit which has not been accounted for, and hence that becomes the excess return. And what happens is after 5 years, not only the length remains same, but the height, because you are starting at a much higher levels of profit, you again reappraise the entire value. And hence Asian Paint is priced in 1991 as say 2000 crore company. In 2000, after 10 years, again the P multiple remains same, but you price it 20,000 crores. So this is, the logic, because this is not like an oil field or a limited profit machines. These machines are literally unlimited and perpetual machines of money. What it is called by Buffett as commercial cows with literally unlimited milk giving power. And you need these kind of milk cows in your portfolios. And there are very few. Mind you, these kind of companies are not only in India, but world over. But Buffets of the world, they have become big because they invested at early stage. Seas Candy, your American Express or Washington Post and Coca-Cola. I mean, these kind of companies they have invested. I mean, these companies are few and far between, even in America. In 8,000-10,000 companies, they also have 100-200 companies which are unique. In India also we have 100-200 companies which are unique. But they will always look expensive. It's like unique buildings. They will always be out of line in terms of valuation. So these companies, they are out of line because their profit-making capability is not only high, but they can keep making money for very long periods of time. Literally, it will outlast us, maybe 50 years, 100 years. And the amount of money which it is going to make is also cannot be fathomed by the market at this juncture. And this EMCs, the competitive advantage companies, they have come from any sector. Future has not been meaningful for EMCs. See, this is one of the difficult thing, but we must understand. You know, everybody wants to know what's going to happen next year, what's going to happen after 2 years. I mean, there's no answer. Even God doesn't know what is going to happen after 2 years. So how any analyst or anybody is going to tell? So the Bloomberg estimates, I mean, which goes wrong by huge margin. You look at the estimates given by the guy, it is not worth even talking about that. It is so bad. So the point is, but that's the best thing you have. Even that goes wrong. So the future is not known, and that's the fun of the market. But the companies which have huge, deep competitive moat, those companies have bought their future. They have secured their future. And hence, their continued profitability is almost guaranteed. So when you buy a blue chip, you are buying the future profitability rather than the past. Though the name is given because of the past performance, but what it assures is the future performance. And in non-EMCs, it is just the other way around. Just the other way around, where these companies, their future is not guaranteed. And that's the basic difference between a blue chip and non-blue chip. And that's why you keep paying high price for this future cash flows, and you see what happens. Payoff metrics of if you invested in EMCs and future turned out to be right between 2002 to 2012, still the return went from 20% to 26%. But when EMC is a non-EMC and it turns to be EMC, then it is 27%, which is the highest. So obviously a company which is a non-EMC, when it becomes an EMC, clearly the return is 2-3% higher. But a company which is EMC, when it moves to remain EMC, it doesn't make that much of a difference. So we tried this thing in Nifty also, and we found that the performance is no different. I mean, if you look at the performance of 38 stocks in 2002, because 12 stocks didn't have either the past data or future data because it got merged or something. We looked at 38 companies, and again the payoff matrix is same, where EMCs returned 22% and non-EMCs returned 16%. So you know the analogy has been tested on Nifty constituents also. So we tried to kind of put the current Nifty into EMC bucket and non-EMC bucket. And here we have, on the same parameters, we have used between 2005 to 12 as appraisal period and 2012 and future into the performance period. And here we have put 27 companies into EMCs and 23 companies into non-EMCs. And so benchmark is also loaded with a lot of highly advantageous leadership companies. So outperforming a Sensex or Nifty is going to be extremely tough because it is 50% or more than 50% EMCs and less than another half is non-EMCs. So you are up against a very, very formidable guy in the name of Sensex or Nifty. So for an ordinary investor, it is very tough. That's why now I understand why most of the managers, they are not able to beat the Sensex or Nifty in the long run. These are the lists which you can get it from our site or from the report. So now briefly about the market outlook. The corporate profit to GDP, I mean, we have just about 5 minutes, but the corporate profit to GDP has been very, very steady at about 5%. It was 7% in 2007. Now it is about 5.2% and is likely to stabilize at about 5%. Nominal GDP is growing at about 12, 13, 14%, and corporate profits are going about 10 to 12%. So we are kind of stuck at about 5%, which is not bad. I mean, in 2002-03 it was more like 3%. Now it is about 5%. So it's a very, I would say, healthy level of corporate profitability, which is growing at about 10-12% right now in aggregate. Interest rate, we know, has been kind of after crashing to 5, we are again stuck at about 8.2, 8.3, and in next 12 months, I hope the interest rate is going to come down by at least 50 to 100 pips on a 12 months basis. The valuation on a P basis, on a P basis is at average level about 15 times, and on earnings to bond basis, earnings into bond basis, it's about at parity. So market is not overpriced, it's absolutely by historical leverage, it's right at the average line mark, neither it is underpriced, nor it is overpriced. So it's a very attractive level of markets. 70% to GDP is the market cap to GDP right now. So getting 12 to 15% that of normal GDP growth rate is kind of can be expected with not much of risk. But if you look at this chart, where the deep blue is the P, which is at average, but the Sensex is almost touching the new high. So with a 10% earnings growth given, you look at the Sensex prediction from Motilal Oswal team, we are saying 1215 will be the Sensex this year, 1215, 1225. Given the kind of margin of error, when they are saying 1389 officially predicting, they would, even in bad conditions, they would reach about 1350. So with that kind of earnings outlook, this is the best outlook one can ever have, at this point of time. So my sense is that market is headed for new high in terms of absolute index number, 21, 22, 23,000, but not in terms of valuation. Valuation will remain at about 15, 16 times. Just the earnings growth will push the market to the new high. I mean, a lot of people, they think that this is a big event, but my sense is it's a very normal earnings growth, which will just put the market into the new high. I only hope when the market goes into new high, the retail should not become mad and take the valuation to 25, 20, 25 PE, which is what is visible now in new issue market. I mean, 70 times oversubscribed, 100 times oversubscribed. So it looks that market is getting excited. So the moment it goes to 21,000, I'm sure there will be far more excitement in the marketplace, and we'll see the again same drama which happened every 7 years between 85, 92, 2000, 2007, and the next destination is 2014, 15. So conclusions: consumer sector has bounced back into wealth creation. Financials has emerged as the largest wealth creating sector for the second time in a row. Economic mode protects the profit and profitability of the companies from competitive attack. Extended capital advantage period of EMC drives superior profits and stock returns. Breach of economic mode causes massive wealth destruction, and markets seem poised to touch new highs in the next 12 months. Thank you.